Thanks. A special treat for you today. We've managed to find this young man, Brandon Munro, wandering the streets of Heathrow. And we've brought him back here for an interview to talk about the kind of macro situation at the moment, give us a little update on how Bannerman is getting on as well. So sit back and enjoy. How are you, Brandon?
Great.
Good to see you.
Yeah, it's fabulous, isn't it? It's such a nice day.
It's a lovely day, and you and I are out there mowing the lawn, preparing. We want nothing but the best for the viewers. So what are you doing over here?
Well, I'm here for a few days, actually the whole week, talking to investors.
Right.
It's an interesting time in the sector right now. You've got a backdrop where equities are highly volatile. Gold is getting all the love.
Yep.
But I feel like we're at a real inflection point with uranium equities at the moment. The sector seems to have bottomed. It's slowly coming out of that. We've got a backdrop of the tremendous volume of shorts on all of the major ASX equities and same on TSX as well. And I feel like that trade has really run its course. So I feel like now is the time for people to be looking back at equities.
Yeah.
And with a little bit of help from the sector, we could see that short trade start to unravel and need to be covered.
Right.
So I'm talking to investors about that and just making sure people have got their eyes open right now.
Okay, the cynical amongst the audience might say, come on, we've been talking about this since 2019. It's the same tightly coiled spring as it ever was. What's really changed in the last 5 years?
We've just seen more of the same in terms of what we knew about the fragility of supply in this sector is actually playing out before our eyes right now. We've talked about the difficulties that both greenfields, but in particular restarts, would have, and now we've seen the evidence of that. So what my message to, for example, fuel buyers and utilities has been for some time is you can't just take what's on the box in terms of what the disclosures are for a mining project or a mining company and just assume that that's the way that it's going to play out. And of course, we understand that in the mining sector. We understand it well as investors. But when you come from outside the sector and you're told very convincing things by very charming people, as capital market players tend to be, the temptation, I think, for the good folk in the nuclear sector, in the downstream sector, is just simply to take that on face value. So utilities being confronted with fragility and disappointments really across the sector, whether it's restarts that on a whole are performing a bit less than expectations, or even greenfields which are either biding their time, like Bannerman is, waiting for the right market conditions, or the greenfields projects that are being challenged by financing challenges or jurisdictional challenges, for example. Now, against that, I think it's fair to say that although uranium and the nuclear industry has been building for quite some time, we have seen progress in the last few years. We're a few years into what is likely to be a long-term bear market. This is not a sector, as we've talked about many times, Matt, this is not a sector that runs on a typical 7-year commodity cycle. It's a much longer cycle length than that. There are several reasons, but the predominant reason is that the customers that are the only buyer of uranium, it is an unsubstitutable fuel source for nuclear power. They operate very, very long life assets, 40, 60, 80-year nuclear power plants, and they have a long contracting cycle, which means that the upswings and the downswings each last for at least 10 years in this sector. Come out of a deep, quite desperate bear market of around 10 years, starting with Fukushima in 2011, and now we're at the early stages, 2 or 3 years into now the bull market on the other side. We've seen a strengthening in demand that in 2019 we weren't expecting. Sure, China's outperformed. China's has a huge build program, but we expected that, and we were pretty on the money the way we predicted that. What we didn't expect was the US becoming a growth market. Mature markets like Europe, which everyone had flatlining in their models, are now growth markets. And basically everyone who isn't trapped in a political ideology of either eliminating nuclear or not letting it start, everyone else who has a nuclear fleet is looking at how do they increase that capacity, how do they uprate the output of their reactors, or in most of those markets, how do we start bringing on both SMR and conventional. So demand is increasing versus where it is. Supply is pretty much playing out the way most of the sector thought it would, but now we see the evidence of that. So, yes, it has been a while coming, but equities are a lot stronger than where they were back in 2019. Bannerman's share price bears that out very well. And for a few years into at least a decade-long bull market, I think we're doing okay. Now, that's pretty different to the last 6 months. So that's been a very difficult experience for uranium investors. But in the fundamentals lens, and when you look at it from the perspective of what's happening in the uranium sector, it's performing very, very well.
Okay, well, there's a few points then. I'll kind of go through them in a linear fashion, if you don't mind. One of the first points you made was around supply, okay? I think there's an assumption that in demand terms, there's enough demand today. It will keep growing, but even if it stopped today, we're good, right? If anything, what we're going to talk about now is we don't probably have the ability to feed into that demand with the supply that we're looking at today in real terms, because we've seen a few hiccups, shall we say, in the US, some high-profile ones. I'll mention names, but perhaps we don't want to. We'll use an example of maybe what may also be coming further across the line. Obviously, Peninsula sort of have had a few issues, delays there. Encore's had a bit of a delay, underperformance in terms of their numbers, and that's hit them in a variety of ways. Peninsula the same, and like the Niger operations for lots of reasons. So those guys, bit later than planned, lower amounts than planned, and that's just the guys who can, the guys who've got the experience to do it. Outside, we'll talk about Bannerman and the bosses and so forth of the world in a second. But there's a lot of people talking a good game, and what makes me nervous is if those recent examples of failure to deliver at all, or at the volumes, or in the time frame concern, there's going to be more of that. I think that is the nervousness around the sector. Well, one, how do you feel about this kind of underperformance?
Well, like I said before, on the whole, that level of underperformance is the mining game. We know through following multiple companies across various sectors, the PFS always looks amazing.
Yeah.
You see capital and operating costs blow out in the DFS if it gets that far. Rarely do companies perform according to their original timing expectations. Rarely does permitting follow according to what was originally expected. And that's just how it works. See, we've got a crowd already.
There we go. So this is Ochre, everyone. Don't know if you can see Ochre. There's a dog here. Guess what we're doing. Hello, darling. Yeah, so he's very interested in what's going on in the markets at the moment.
But what it underscores is it's tough work. It's really tough work.
I think that's the point.
And it's really important for investors, I think, that if they're not able to challenge management directly, that they go to sources that will challenge management so that somebody is ensuring that management actually has their eyes open, that they aren't just pushing forward with a bunch of blind spots. And I can talk from personal experience with Bannerman. We spent the last 3 years at the company re-engineering our organisational capability to be able to build a Tango. So when we first started talking, 5 years ago probably, with the Energy Show, the Bannerman was very different. The main priority for Bannerman was capital management, stewarding the asset through a really difficult bear market, making sure that shareholders still had value at the end of that, ensuring that returns would reward that extraordinary level of patience that was required during that time, making the right decisions, having an appropriate strategy that meant that the asset was intact and ready to perform when it came out the other end. Now, by and large, I think we achieved all of that, and our share price performance has shown that with a lot of volatility, but we're still in really good shape compared to where we were. That's really different to the Bannerman today because of the level of evolution required from those disciplines to building on time, on budget, without commissioning issues, a significant uranium.
Let's talk about exactly what that means, because if people are learning, management teams are learning on the job, I usually have quite a problem with that, because that's at my expense. I have to pay for those mistakes and those delays, etc. So what does it mean for you in terms of the type of people and their function? What exactly are you asking them to do?
You know, the learning on the job is really a big issue, because you and I know lots of people who are exceptionally capable. You know, real smart people, they can learn new things, they can learn it really quickly. But very, very few people anywhere in the sector can come up a curve quickly enough to be in front of a construction process. It happens so quickly, there's so much to know. So in our case, number one is we needed to find the right CEO who could build a Tango, who had the in-country knowledge, the commodity knowledge, the networks in Southern Africa. And ideally, and what we found with Gavin Chamberlain, was somebody who had such big runs on the board that a Tango was actually kind of a bit simple for them.
And you stood back, sorry to interrupt, but you stood back knowing that it's pointless you trying to manage something at this phase.
Correct.
Yeah. Okay. Unusual. Just I say it because it's unusual. Sometimes people get so ingrained that they think they can go through the whole phase. So I thought it was a good move.
And look, I had plenty of people encouraging me to do that.
Yeah.
So if I'd wanted to, if I'd been
to
misled enough, to stay.
not to go.
I've probably had many of those. They just didn't tell me.
Right. Yeah.
But seriously, many investors, many others saying, no, you can do this. And luckily, I had the support of the board to implement a strong succession plan, and in that we found Gavin Chamberlain, who's then been able to fill out the rest of the organisation.
Let's look at that. But let's look at it. I really want to get into it because I get nervous about this sector. I don't think we can have any screw-ups in this sector. It's too small a sector, and if there's a screw-up, it's not good for the rest of the sector.
Correct.
So some pretty big names, some pretty big projects, some pretty big numbers in DFSs and feasibility studies too, which sound great on paper. They sound fantastic on paper. But the reality is, and we see this in the gold sector and silver and copper and everywhere else, it's difficult. It's not snowing. These are cherry blossoms, folks. We need to be faultless. We need to be perfect, the uranium sector. So when someone like Gavin, he got a little bit of snowflake there. When you see someone like Gavin coming in, what you want him to do is be faultless. So what exactly does he? What's the risk management that he's doing?
Yeah, so
it's great. Everything's great on paper, right?
So first of all, I'd encourage investors to talk to CEOs, whether it's uranium or other mining sector, and ask them about execution risk.
Yeah.
Ask board members about execution risk. And if you get a half-baked answer, it means they're not spending enough time thinking about it.
Right.
And, I can talk again from a Tango. So any of the folks out there in our audience who know a Tango or Bannerman well, they understand that it's actually a very simple uranium mine as far as mining goes. It's open pit, it's at surface, it's a low stripping ratio, it's in Namibia where the country's very accustomed to doing bulk tonnage. It doesn't have the political or social risks that you might otherwise be up against during a development phase. We're in a very simple, arid environment with no people, and we have a very cost-effective heap leaching process that's as simple as it comes. Sulfuric acid, we've tested it to death with the demonstration plant that you've climbed all over yourself.
Yes.
Yeah. Now, even though we've got all of those attributes that make our project very simple, there's still a huge focus on execution risk, because even small things can cost you time, which then costs you money, which costs you momentum. So some practical examples. So Gavin's come in with his experience. The first thing
Sorry, what's he done before?
Okay, good point. Gavin's got about 30 years of building mines and infrastructure projects in Southern Africa.
Okay.
He's also gone to more exotic Africa. Okay. But what we liked about his experience is it's not singular. He's worked as an EPCM contractor, and in that capacity he built the Husab uranium mine, which is still Africa's largest uranium mine. Right. I think when he was building it, it was the single largest mining development on the continent. Right. But he's also worked on the owner's team side, so he's been doing inside other companies, bigger projects, what we're asking him to do now. And he was an MD of a contractor at one point as well. So the three most important dimensions for we're looking he's got covered.
Right.
And obviously that operating environment in Namibia specifically, but the broader Southern Africa. So he comes with a really strong network, a really good black book of people, and we've already seen that the way he's adding to the team.
Is there anything that he's said to you which surprised you in terms of what risks need managing? Because there's all the kind of stuff that I say most investors could probably list off and go. But is there anything that surprised you about the things that he was like,
I mean, if I think early when he came in, so Gavin's been with us, it's coming up to 3 years now, coming up to 18 months as CEO. He started as Chief Operating Officer.
Yeah.
So in the early days, he started just after we published our DFS in 2022. And I think he said on your show how he was rubbing his hands, looking forward to finding all the holes and coming in and having a big impact.
Yeah.
However, one thing that we did really well, and this goes back to my comment about blind spot management and just recognizing that most of us, there's a whole lot that we don't know, and you've got to bring the right people in to identify your blind spots and plug them. So as we were going from a Tango 8, we made it smaller from the enormous development. So we originally, when I started, we were looking at 7.2 million pounds per annum.
That's right.
And we worked out that we could make the mine smaller.
Yeah.
Initially produced 3.5 million pounds per annum for a much reduced capital and a much reduced risk profile. Once we're in production, we then expand to 6.7 million pounds.
Yeah. Yeah.
So as we were going to the PFS on that and then through to the DFS, we had a panel of technical experts who met with me weekly and the project team, and just their main job was what might you be missing in the way that you're doing the study, the way that we were handling the consultants, the way that I was managing my own team, because I was CEO back then, outside of my expertise.
Let's talk about consultants. Consultants are great. I've done it in the oil and gas side of things, not obviously in the mining side of things. Pretty much write what you want. They write what you want. You're paying the bill. They write what you want. How do you feel about that?
It does depend. I think as an investor, you get more reassurance the bigger the name.
Yeah.
Because the incremental fees that they earn on a particular job push up against their reputation. Yeah. So we use Wood Group, which are the largest in Africa, Wood PLC. They've also got a big profile in the downstream nuclear industry. And they're quite protective of their reputation. So unfortunately, as much as I'd like to say I did get them to write what I wanted them to, it didn't actually work that way.
You don't want them to. You don't want them to, is the truth, if you're serious about it. But if you're not serious about it and the end game is we're going to be taken out by the Chinese, we're going to be taken out by a bigger player. If that's the game, you just want the numbers to look pretty, which is as you know more than I, is false economy, because when the big guys come in, they rip up your data room apart. Even decent bankers, quite frankly, rip your data room apart. They catch you out. But I see it all the time.
And I tell you where they really rip it apart.
Yeah.
Not the M&A due diligence, the financier due diligence. Yeah. One of the people who is on that technical advisory committee, John Turney. He still consults to us regularly. Yeah. When I first worked for Bannerman in 2009, some of our audience will remember that I started with the company and my job was the environmental clearances. Went and lived in Namibia for several years working with Bannerman back then. John was our project director and he was the equivalent of a COO for us. Real deep experience. And he had an absolute mantra. He said, we are doing this technical work to actually build a Tango. And at some point, we're going to have people coming into a data room whose job was what his job used to be, which was tearing apart the technical data, finding the flaws, handing it to the commercial guys who do the negotiating and saying, right, rip these guys to pieces because they've cut that corner or they've got this flaw or they've got this issue.
Yeah.
And he said, and if we get through all of that, we're going to have banks and independent technical experts coming in whose job it is to make as many problems as they can, because it's their fine-tooth comb that earns them the respect of the financiers, because they're trying to push their financing risk, as you all know from banking, they're trying to push their financing risk onto the technical experts.
Yeah.
So you really, really get the bright light shined on the quality of your technical data as you go through those due diligence processes.
If you ask for it, a lot of companies don't. So I think I appreciate what you've done.
And it's a really good question to ask. You often get told shovel ready, advanced.
Yeah.
Financing's going to be fine.
Shovel ready, hilarious phrase.
So we use that one, but we use it in a very particular way. And the shovels have been moving on a Tango, so I guess we can.
My point is that it's the proof points behind it.
Correct. And if a company, whether it's uranium or another sector, is talking about financing, advanced financing, the best question to ask is, well, has it come out the other side of finance due diligence? Because if it hasn't even started, and sometimes there's a couple of companies in our sector that are talking about that in their announcements.
Yeah.
If it hasn't even started, then that can be a long and difficult process. And as you know, we've had advisors appointed for more than a couple of years on our financing. So we've had the opportunity to address all of that.
Okay.
Against the background of John Turney enforcing
the mantra
that this needs to stand up to due diligence scrutiny, otherwise it's not worth doing.
These are all valid points, and anyone watching this should, please, with the companies that you're invested in, be asking these questions, because again, there's a lot of advanced development stories out there, which I feel perhaps they could be stronger. Let's put it like that. Being nice today, aren't we? See, the sun's gone in as well. Crikey. Right. Okay. So just going to bring it back to kind of the wider
execution risk, and
if you don't mind, because that's the key here. Because when I talk, I do a lot of macro interviews on with various metals and so forth, and we did a fantastic one the other day with Alex Black of Rio 2, good old Aussie. And, he was talking about the need for sort of quality management teams who sort of, been there and done it before, obviously. And I said, well, what precisely are we talking about? Well, it's about your view on their ability to execute perfectly, flawlessly. That's what you're buying into, not the theory of doing it, not the learning on the job thing that I'm talking about. So execution risk is paramount. So how do you target that? How do you measure that? How do you reassess that? How do you continue looking at new things that come up which will affect your decision making?
And there is no such thing as a flawless execution. Every mining development, every construction has things go wrong the whole time.
Right.
The question is your delivery, your endpoint delivery flawless or on time and on budget and according to spec?
Okay.
It's a constant firefighting exercise. So some examples. You mentioned consultants. So Gavin Chamberlain ran, it was then AMEC Foster Wheeler, and it's now Wood PLC. He ran their whole African resources business. So deep experience about everything from, what their incentives are to what their challenges with keeping people, and he really knows how the organisation ticks. We've got 2 full-time people who sit in their office in Johannesburg. Mm-hmm. They've now got a whole floor for a Tango. There's about 70 engineers.
What do you mean we? Are they
Bannerman.
Their employees, your employees?
Our employees.
So your guys sit in their offices.
Our project director.
Why do that?
So our project director and our commercial manager both sit in Wood's office.
But tell me why you've done that. Why not just use their guys?
Because they've got to be controlled and incentivised.
The right way.
The right way.
Yeah. Okay.
An engineering shop, they're under a lot of pressure to do various things. They're under pressure to meet deadlines. They're under pressure from their own perspective to bill. And they can be formulaic. If you don't have someone pushing them to constantly, no, you've got to find a better outcome for us.
Not a template, not a cookie cutter. Our version. Right.
Yeah.
Okay. Interesting.
So first of all, they can be formulaic. They can, just do things the way that they're normally done, and you've got to be constantly pushing them to find the better outcome. There can be, like any organisation, things fall between the cracks. You can have the right hand not talking to the left hand. You can have their right hand not talking to the company. The lot falls between the owner's team representatives and the consultants, particularly when you're under pressure. They go charging off in one particular direction, and no one's there to say, well, is that really the direction we want? One of the things that we've found is tremendously beneficial for managing execution risk is we've done what's called 5D modelling. So basically, it's 3D modeling that has full functionality with how the mine will operate in practice.
Okay.
So it's great. You can put on the VR headset and you can walk around, say, the primary crusher. You can simulate maintenance. So that the example that was given to me is where these things really pay for themselves is you simulate a maintenance and then you go in to, say, take a grinding roll out for our tertiary crusher and then you find out, that gap there is a metre too short to bring in the conventional crane. So, whoopsie, you'll have to get a bespoke crane, which costs another $1.5 million.
Right.
Now, you find that out during a 5D simulation of the entire mine. You can just adjust it now before you're actually constructing it. It's an incredible training reference as well.
Yeah.
In practice, you use it in ways where you do for example, maintenance again. You do a simulated maintenance plan where the day before you go in to do a maintenance, you can go in, you can tap on the particular icon really as you're doing it in the virtual world. You can see the spares, you can see what needs to be ordered.
Yeah.
You can check that against what's actually in the spares. There's just a huge amount of efficiency both when you're in operation but also during the planning phase when you're actually in the detailed design. So that's another thing that we've done. Another mantra that John Turney just constantly talks about is you get project builders and you get operators. And they're very different sort of people.
Yeah.
You know, the project builders, they tend to move from project to project to project. They're very, very focused on just getting it done on time, on budget, and moving on to the next thing. Yeah. Not often do the project guys actually have to wear the consequences of what they built and how well it operates.
I think that's Alex was saying the same thing. Is because you build it doesn't mean you're good at operating it.
Correct.
Yeah.
So it's really vital that all the way back to the study phase, when you're formulating your DFS and then in our case going through front-end engineering and design, it's really important that you've got that operator input. Those people will say, well, I know you can build it quicker doing that way, but when it comes to operating this mine and actually getting the throughput through and doing the maintenance and doing all of this, what you've just designed there is actually a pain in the bum.
Yeah.
So we've gone to extraordinary lengths to back integrate the operational state of the Etango mine with how it was designed right back to study phase. Yeah. And again, that's just the experience of guys who've done this many, many times coming in and making those suggestions. And Gavin appointed a South African group who actually specialise in operations, construction, integration. Normally they come in during commissioning, and he's brought them in now, before we've even started constructing.
We spend the money, or too much money.
Yeah, exactly.
Okay.
Another thing that Gavin's done that's been really handy is knowing the Namibian market really well and having direct experience building big mines in Namibia.
Yeah.
He broke up some of our bigger contracts into smaller contracts so they were bite-sized for Namibian contractors. Mm-hmm. Now, there's a big in-country dividend, of course, because everyone wants you to use local resources. But for us and for our investors, the big advantage was we're not mobilising from South Africa. Now, the risk is, in doing that, if you don't really know what you're doing, you've got more moving parts that if you had the one bigger contract, you'd have a head contractor who's in theory responsible for all of those pieces and you don't have to think about as much. But Gavin's philosophy is you've got to be breathing down all of your contractors' necks and making sure that they're managing properly.
Absolutely.
Because if they stuff it up, it's too late to say, well, you stuffed it up, that was your fault. Yeah. Because the project's moved on, you lost time, you've lost money, you've lost effectiveness. So he said, look, we'd be doing most of that management anyway to make sure that our contractor's doing the right job. So let's back ourselves to manage the interfaces between those smaller contracts, which then got let to Namibians, and they're doing a great job. So we haven't had to mobilise them. We don't have all of the costs of them coming out from South Africa. We don't have the strain of finding where do we house the workforce, how do we feed the workforce, because they're locals who are so far doing it.
It's interesting. I mean, you're, like you said, you're relatively simple process that you've got. It's shallow. It's it's heap leach. It's all kind of simple stuff. If I'm looking to the American market, I guess the question I'm trying to answer, and a lot of retail are trying to answer at the moment, is like, who the heck is going to get this right? Where's the supply going to come from? Because we seem to be hurtling towards a point where there's just not going to be enough, and therefore does that give the utilities another big question to answer? Is like, is uranium, is nuclear going to get its act together, right? So there's this a big question out there. Simple project. We've seen a few recently which are more technical. They've had technical issues, technical like ISR issues, which is meant to be simple, it's meant to be cheap and all this sort of stuff. But here we go. It's hard, as you said earlier. Mining's not easy, small fires every day. But where will perform? I mean, Nigeria seems to be a basket case at the moment, right? Not a good advert for Africa, quite frankly. We've got Malawi, Lotus seems to be sort of ticking along. We'll see how it goes. Paladin maybe should be playing catch up a little bit from their Q4 numbers. But which jurisdictions are going to produce the pounds that we need? Because everything we took multiple occasions, we've talked about Kazakhstan and any of the stars that are producing seems to be doing tie-ups with China, with Russia, and it's all just heading east. That's not in it. The Americans have got bits and pieces going on. I mean, 2 million wheelbarrow sometimes stuff where the production's just not there. Are we gonna, as an industry, get our act together enough to be able to meet supply? And if so, where do you think it's going to come from?
Well, there's no easy and simple answer to that. So far, particularly in the bear market when the sector was oversupplied, the answer was Kazakhstan.
Yep.
But these are tier one assets that have been known about for a long time that were not brought to life because in the Soviet era, it was a command economy, and the command decision was we're going to start with Russian uranium, and once we've depleted the Russian uranium mines, then we'll move on to Kazakh uranium. And then, of course, when the Soviet Union fell apart, the Kazakhs were able to shake off that control and bring those assets on. But these are a handful of incredibly good assets in Kazakhstan that have been fostered for several decades, which means it's not as simple as saying, well, we're going to find another cohort of those high-quality Tier 1 assets. There's maybe one extension in Inkai South, and perhaps there'll be something else that comes out of the mix. And then most people who understand this well believe that there will then be a step down into, out of those real good quality Tier 1 Kazakh assets. So fast forward by 10 years, mid the next decade, it won't be the singular answer, which is cheap pounds out of Kazakhstan that we've had over the last decade.
Yep.
And then you run through the different jurisdictions. First world jurisdictions have got challenges. Canada's got challenges. Australia's got challenges. You've talked about some of the developing nation jurisdictions that can vary between relatively straightforward in Namibia and incredibly challenging like Niger. The US, of course, is a huge market for uranium and has been a big producer in the past, but you'd have to be a really brave person to project substantive production coming out of the US in the next 10 years. And then you're going into other jurisdictions such as Uzbekistan, Mongolia, that have got their own challenges. So this is a very supply-challenged sector. And Namibia, it's already the third largest producer of uranium in the world. And it's been producing uranium for more than 45 years through Rio Tinto's Rossing mine, now owned by CNNC, the Chinese nuclear giant. Namibia will play a bigger and bigger role, not necessarily because they're the best ore bodies in the world. That they're a very different grade profile. They're simple because they tend to be bulk tonnage, but they don't have the grade that matches Athabasca. But because it's a simple operating environment that is well accustomed to uranium, that doesn't throw a whole lot of roadblocks in front of it like the Australians are very good at doing, or even the Canadians. Yeah. So there isn't a single answer where supply is going to come from. There will be enough uranium. It's just that it might require some extraordinary incentivization to bring it to be. And obviously that's what a lot of investors are excited about.
Yeah, I think with I guess another sort of bit of news in the sense that, Denison's decision making being delayed, next gen bit delayed. Yeah, and it's kind of like, well, this whole process that we're kind of going. Would you like some water?
Let
me just.
Oh, there it is.
Goodness, here. Look at this. Service with a smile.
All of the work in the fields has made me thirsty.
It's thirsty. I would offer you a beer, but that might change the nature of this conversation. Afterwards, we'll do that afterwards. So it's just this sort of continual delays in the market, and I sort of alluded to the fact that perhaps some utilities are of the belief that the Red Book is true, and that supply will be here when they need it. At the volume that they need it, and I'm becoming less and less sure of that. The more I speak to people in the industry, the more I speak to some of the companies trying to understand the challenges that they have, and that concerns me. I think it's a fantastic opportunity for companies like yours, where we talked about the meticulous process of building a company to then have mind builders, and then be talking about how you operate it in a relatively simple, technically simple project, and you've had the bankers at it for a while. So I think you understand what the moving parts are. I'm not talking about Bannerman, but I think there's a lot of examples of companies that perhaps maybe even misleading the utilities, let alone the market, the public market. So I think that worries me somewhat. And I don't want to sort of get into names, but there's enough of them. So here's the question: why the heck aren't utilities more switched on? If I look at, and I've got to give credit to UEX, and I've got to give credit to Trade Tech and people like that, when they were sort of talking about price point in the market in 2019, 2020, I'm like, what do they know? It's going to be flying. We're going to be flying. They're too conservative, but they nailed it. They nailed it in lots of ways. Their assessment of the market has been nothing short of brilliance, because they take the market data and they discount it. They go, I'm not a believer that these timelines will happen. So they're getting it right, but utilities seem to be slightly more optimistic, it seems. I mean, what do you hear? What do you know about the way that utilities are behaving in the market? Are we going to get some relief from them soon? Some hope.
So look, there was a time when I think utilities themselves would look back and acknowledge that they were underestimating the challenge of new supply coming in.
Yeah.
And certainly at that stage, they'd probably become accustomed to cheap prices and underestimated, as a whole, the utility underestimated what incentivisation would need to do, particularly for greenfields. That's not really the issue at the moment. So it's not so much that you can point to utilities and say, gee, they're getting it wrong. Maybe at the margin, they still need to understand a few more things about the complexities and challenges of bringing new supply on. The real issue is that for the last 12 months, even longer, they've been totally distracted by bigger issues than their immediate uranium requirements. So if we go all the way back to January last year, spot price was flying, everything looked great. The utilities were getting ready to start addressing that supply risk. And then the Russian sanctions bill passed through the US House. And then 10 days later, the Biden administration signed it in. And we started this process of utilities saying, well, we'd better just wait and see what happens with our waiver applications. Or even the non-US utilities thought, well, we won't act just yet because the price is going to depend a bit on what happens to those waiver applications.
Yeah.
A 90-day process got extended, it got extended. There was a little bit of contracting activity in September last year.
Yeah.
But then as the US election started to get closer and more things were being said about the IRA, the Inflation Reduction Act and all of these other aspects, the utilities went, oof, this just looks way too complex.
And you've got the Section 232 as well now.
Now we've
included
here we
in
are.
that.
Yep.
That's in October.
Deja vu.
That's October again, right? So I can see this cause for delay because you don't want to get caught out. Heck no. But boy, oh boy, they're cutting it fine, says the average retailer. Surely the inventory levels just aren't there yet, or are they? Is there still enough mobile inventory which we're discovering, which we're not taking into account? Why are utilities so relaxed about all of this?
Well, They're not that relaxed. They want us all to believe they're relaxed, of course. These are very experienced negotiators, and every so often someone, commentator or a company CEO, claims that the utilities just don't get it. These are really smart, professional people who've been in this game for a long time. So, of course, they project the view that they're relaxed. But we know through our discussions with them and through what they're doing that they are actively concerned about taking steps to address the U308 supply.
Okay.
But they're terrified about enrichment and conversion.
Right.
And that's really the big difference here. So the tariffs totally paralysed the utilities decision-making for good reasons, appropriate reasons. What was really important is about 3 weeks ago, we saw that uranium and nuclear fuel products were exempted from tariffs.
Yep.
At the time, and we've said this on some of the Bannerman quarterly webinars, and I've been talking to investors about the fact that I saw that as a cue for the utility starting to get more involved in the market.
Okay.
There isn't mobile inventory of any degree right now. You asked about inventory.
Yeah.
So mobile inventory is the inventory that is looking to be sold or can move around a whole lot. The traders have got material and there's a lot of churn between the traders.
Yeah.
But we've moved through the era where there was excess sloppy supply that was highly mobile, that is the inventory that hurts. There are still commercial inventories. There's a fair bit of difference between utilities. Some are well covered, some are less covered. The European utilities tend to be better covered than the US utilities. Mm-hmm. And that gives them time, but it doesn't give them a solution. And so they've been using that time, they've been using that comfort to enable them to wait and see and stand back and see how some of these regulatory matters follow through. It's my view that they can't reasonably take the balance of this year. So in other words, I think that if they haven't come to market by the end of this year, we're going to see a very exciting September, October, November. It might be that they come sooner. What's been interesting for me is watching the spot market, which is...
Well, that's why I asked the question, right? Because it seems... And I get asked it every day of the week, right? I've got fund managers calling me up and going, right, can you talk to this guy, that guy, find out what that's going on. It's like spots at mid-60s. We had a little spurt over the past few days, end of the last week. And term seems to be people talking about 80, 85, that sort of level. But those are term contracts with people who aren't producing. So it's like, is that like hedging against what may come in the future? Is there a sense of where utilities or buyers think that, I'm not talking about traders, I'm talking buyers at utilities think that spot will have to return to?
I think so. I
think
so.
Okay.
So you say a little spurt. It's a little bit more nuanced than that, what we've seen in the last week.
Yeah.
So we've seen a uranium price that started the week at 65 and ended the week at 66.50. And you might say, oh, gee, $1.50, what does that mean? What's more interesting than that is the uranium price edged up every single day. In the context where we've gone a week where the uranium price has barely traded recently, and we've had a real flatlining uranium price at about $65 for several sessions. Now, that's off the back of only 6 trades.
Is that right?
£550,000, according to Trade Team, less than the average for the year. So what does that tell you? It tells you that the buyers are determined enough to bid the price up. It might only be 25 or 50 cents each day, but they've had to bid the price up. And that's consistent with what we know, which is it's utilities returning to the sector. Right. They've had their hands unshackled with the news about the tariffs. Now, they're probably still a bit cautious. You can't take everything on face value for certain at the moment with what we're seeing with trade wars and the White House policies. But at least some of them have had enough confidence to start buying. These are the sort of factors that entice other market participants to buy. You see traders who will come in, and for the first time in weeks, we're seeing signals that the uranium price is going up. It's not just bumping up, going down like it has been. So I think it'll bring its own momentum in some form. It indicates for the first time in really the last couple of months where we've had real demand in the spot market. It's a week. Okay, so
Yeah,
you know,
I
we
was basically,
might
calm down,
be
Brandon.
we might be looking we might be looking back, but
Yeah.
it's important to me because it
Yeah.
signals of utilities coming back into the spot market for the first time. We know why that's happened because of the exemption of nuclear fuel from tariffs. For them, it's a great deal. You know, they're writing term contracts at 80 and they're buying uranium at 66.50. And that will bring other utilities into the market saying, well, I'll have some of that bargain. Thank you very much.
Yeah.
And then the next step that you would see is utilities start to say, well, we don't really want to use our balance sheet in the spot market at the moment. Maybe we still need to keep that fresh for enrichment or conversion, which is a more critical need. But, you know, that trader's just come to me and he said, look, how about a 12-month delivery at $71? And, that's a good deal. So I'll take that. And then the trader has to go into the spot market and buy those pounds so that they can carry it forward for 12 months delivery. So you will see those factors. I believe we're seeing the sector that's bottom now. And whilst it could still bump along the bottom for some time, it's the first real sign of green shoots that we've seen for a couple of months.
Yeah, I think what I'm like, I talked about some of my concerns, but there's some things I'm liking at the moment. Is there's a more realistic conversation going on. I've complained many a times with you on the show about this kind of yeehaw moments that we've had for the last 5 years. I think after 5 years of yeehawing our way through this, trying to say, oh, this is the next catalyst moment, and that we've now sort of seen it sort of, go on the, very ripping highs and then coming crashing back down to reality. I think that's good. It says we're moving from a sort of nascent industry, a nascent view of how this market works. We're nothing special. We're like everyone else, like every other metal. And there's a dose of realism coming back into this. And I like that because once you see enough companies fail to kind of hit targets, once you see companies continuing to sort of delay, getting back into production because it's not going to be an overnight success. It's got to be based on good work to understand exactly how you don't fall over and how you do deliver it into a marketplace. When you see a lot of people who are struggling to make discoveries, explorers struggling to make discoveries, it's hard. Everything about this is hard. And I like the reality that we are all now learning from. And I think a few disappointed people out there, but that's fine. We've all kind of grown up together in this little space of ours. And I like that. And I hope that continues. And I hope we don't return to the yeehaw moments, over the next 2-3 years as we kind of move towards these 2030 delivery dates, which everyone's talking about. It's got to be good old-fashioned, fundamentals-driven, rationale on valuations, but also behaviors within those companies from the management teams, because it's mining at the end of the day. It's quite complicated, it's geopolitical, and all the lovely stuff that we've talked about. But let's get back to basics, I think, for me.
Yeah, that's all good stuff. What I would say to that is that I think that when it comes to equities right now, yes, the realism in behaviour is good for people to see. It empowers investors to ask questions. It empowers people to be a bit more careful with their investments. But I do think equities are overdone. I think
Meaning what? What do you mean?
The pricing at the moment is not reality. It's oversold across the board.
You're talking about equities and markets. I'm talking about what can the company do.
Yeah, okay. So expectations.
Yeah.
Expectations, management behaviour and so on.
Correct.
We're on the same page.
Yeah.
I think when it comes to equities, valuations and sentiment, I've been in this sector pretty deep since 2009, as you know. This is the biggest disconnect between fundamental realities and equity sentiment, including spot market sentiment, that I've seen since Fukushima.
But look how many people have under-delivered. Okay, my point is, if you're going to get into this space, look for the fundamentals in the company, the management team, their plans, the strategy, the who has done it, been there, done it before. All of those wonderful things matter. It matters. And if you see a company that's doing that, you want to get behind them. There's a lot of yada, yada, yada out there. And I think that damages the sector as a whole. We've seen it. And like, this isn't specific to uranium, but given we're talking about uranium and energy, we've seen a lot of that since I re-entered the space back in 2019. And I think there's a lot of disappointed retail going, well, you've let me down. You've not done what you said. But of course they have.
That's still been very stock specific, though, in fairness.
Okay.
This time last year, I think a number of stocks were priced to absolute perfection. You talk about flawless delivery. They were priced as if their delivery would be absolutely flawless.
Yeah.
Which for some of them, given that they'd already started writing their contracts, was just going to be impossible. If for no other reason, even if their execution was flawless, their pricing exposure wouldn't be.
Yeah.
So that needed a reality check, and it certainly got it in the second part of last year. But my assessment is that reality check has now sunk all boats in the harbour. So this sector did suffer a bit from the rising tide lifting all boats. I used to look at some of our peer equity valuations. I think we're agreeing
again. That's my point. It's like all boats, rose together in unison according to what the spot price was for all bizarre things. And the point is, not all those boats were seaworthy.
Yeah.
And unfortunately, when it comes back down again, the seaworthy ones get grounded just as much as the unseaworthy ones do. And that's my point. I think that's unfair. And maybe that's a market behavior, standard market behavior. But I'm disappointed that if I'm an investor, I would like investors get behind the good companies and see the not so good ones for what they are. So don't reward everyone the same. Don't have a blended approach to risk across all companies, because they are all very, very different.
Well,
we're disagreeing a lot today, Brandon.
It's like it must be the weather.
Yeah, it must be the weather.
So yes and no. The no bit comes from how the equity market is structured in uranium. It's still quite dominated by ETFs. Now, that's not disagreeing with you. It's actually putting more responsibility on individual investors to do their work, because everything looks good to a point when the ETFs are capitalising, and we've seen that again in the last couple of weeks. Another reason why I feel like this sector is starting to turn.
Yeah.
But ETF flows will reward the good, the bad, and the ugly. But when things turn, when things move, when companies actually have to deliver, ETF flows won't save them.
But do you think you see the same thing in gold? Do you think gold ETFs have the same thing? They'll back any old rubbish as well as the good stuff?
Well,
or do you think uranium?
There's a bigger range in gold. So
the
ETFs back capitalisation in gold, and there's a more sophisticated investor class who will ensure that, to an extent, the better assets and the better management team and the better company gets capitalised in the first place.
Don't have that sort of thing?
Well, they're non-discretionary. I mean, there is some discretion. Some of the Sprott products are a bit better because they can tweak.
Yeah.
They're not just purely a capitalisation-based index like URA is.
Yeah.
So I think they work better. The North Shore ETF is more discretionary like that.
Okay.
But you can't be too picky because there aren't enough companies. You can't run an ETF with 3 investments.
I think that's the problem with the uranium space. It's so tiny. It's always been the problem. It's been the tiny problem in terms of like the types of funds, banks or funds. It's too small for them. The values of the companies were too small, and obviously that's changed and evolved a little bit. But it's much misunderstood, much undercovered by these people as well, because it's technical, it's geopolitical, all this sort of thing. So we've really struggled in this space.
Well, look, I mean, it's been incredibly difficult for investors, particularly who have a short-term outlook in the last 6 months, 12 months even, no doubt about that. But yes, it's challenged because it's small, but that's also the opportunity. When you've got such a small sector like this, the opportunities that rise to the top will do so spectacularly. Yeah. And so that's a reward for investors who can hang in there and who've got a long-term outlook, and in particular, who do the work and back the good quality companies over the companies that have different risks.
Okay. That's so difficult.
Yes.
Apparently it is. Bloody hell. People, I see I get a lot of inbound, and I've lost money in this uranium. It sucks. It's awful. It's that. People have made money in the last 5 years. Timing's everything. So is the quality of the asset that you're after is everything. And that's why you come back to it, and it's like, simple time. You need a good management team. You need a good management team who can execute. You need a simple, big asset in a jurisdiction. We've listed, if we went through this, you've listed all of the things which can be problematic. Say you can have super, super high grade, but if it's a difficult jurisdiction, and you're not going to get the licenses, permitting, all of those wonderful things. So it may be the technical challenges around bloody, weather, water, whatever the heck. There's a lot of variables here, folks. So that means there's a lot of options, but ultimately it comes back to the management team's plan. Do you understand it? Does it make sense to you? Honestly, do not do the all boats float on a high tide thing. It won't work going forward. I'm telling you. Right, we better wrap it up there because we've got a.
You must have some more work for me to do around here.
You're an Australian, right? I understand. This may be a cliche. Tell me if I'm wrong. You're good with barbecues.
Well, I wouldn't be much of an Aussie if I wasn't.
Right.
At least my kids think I'm good with barbecues. I suppose there might be some critical feedback coming up.
Very critical. So my wife has some stuff prepared. We are going to take advantage of summer today, isn't it, Tom? Is this summer? Yeah, sorry, brilliant. Okay. Yeah, today's summer. So we're going to take advantage and get over there and have mown this lawn and put a few, I don't know about shrimp, but we'll definitely put a lot of meat on that barbecue.
Did I tell you I bought your favourite Semillon from the Hunter Valley to go with that barbecue?
A nice cold wine. We're going to do wine. We have filmed wine tastings, but I think this one could get a little bit much for the it might be maybe rated 18.
Not everyone understands Semillon. I think.
No, don't go there. Now I'm going to have to do a joke about my 1970s style microphone. Have you seen this? Right, folks, we're going to wrap it up there. Thank you very much. And Brandon, lovely to see you.
Always a pleasure.